Hello, in this video we're going to be discussing monetary policy. So we learned about the Federal Reserve last time, their structure, what they do, and now we're going to be talking about the specific policies and how they affect the aggregate demand curve and the economy overall. So monetary policy is the tools that the Fed uses to influence the economy. So some of the things they do are direct. They can directly set certain interest rates, they can buy and sell securities, they have actual actions that they can take. But a lot of the impact that the Fed has on the economy is actually indirect through their control of the money supply. So the first and most important tool most often used is called open market operations. This is where the Fed is changing the money supply through the buying and selling of securities, usually treasury securities, some kind of debt securities. And so what they do is when they buy securities, they're taking debt out of the market, they're keeping those assets at the Fed, and they're exchanging that for new digital currency. And so they buy securities, they increase the money supply, and then indirectly change interest rates. We'll talk a little bit more about that on the next slide. They also charge interest on bank reserves. So the Fed is the bank for the bankers. It's the bank for the federal government. So if Chase Bank wants to have their own savings account, they will go to the Fed, they will open an account, and they will keep some of their reserves at the Fed account so they can earn interest on that. They also charge or can change the discount rate. And the discount rate is the rate that they charge banks for loans. Okay, so they're going to, if a bank, Chase Bank, needs to get a loan from the Fed, the discount rate is the interest rate that the bank will pay for the loan they got. Interest on reserves, they're going to pay banks to hold reserves. And then the last thing that's on the list is required reserves. So the Fed can just regulate banks and say, you must keep 20% of all deposits on reserve. Max, you can lend out 80%. Or if they want to slow the economy down, they could say, you have to keep 40% of all deposits on reserve. Now, this is no longer in active use. As of 2020, they discontinued this practice, mainly because they didn't see it doing much. Banks were often keeping excess reserves anyway, and so especially for like stimulating the economy, this wasn't very effective. However, right now, with high inflation, when their increase of the interest rates weren't really doing much to slow down the economy, they may end up going back to required reserve policies if needed. So they didn't eliminate their ability to do so. They just said, we're not going to do this for now. And so indirect, the money supply changes are going to influence interest rates in the overall economy, which then cause shifts in the aggregate demand. So interest on reserves, discount rates, this is an interest rate that they're setting directly. But the main interest rate in the economy, so the rate that banks charge each other, the rate that banks charge their customers to get a home loan, or what they charge businesses for a business loan, the Fed doesn't actually directly control that interest rate. Instead, what they do is they control the money supply, which then changes the price of money or changes that equilibrium interest rate. So their biggest effect on the economy is actually an indirect effect. Monetary policy tends to have a quick influence. Sometimes just announcing that the target rate is changing will cause movements in the actual rate without any further action needed from the Fed. So it tends to be fairly quick, a fairly quick acting type of action. Okay, so let's look at open market operations in a little bit more detailed. So open market operations is one of the main tools that the Fed uses. So if you remember from our other our other video, we talked about the FOMC, Federal Open Market Committee. And this group of people, right, the 7 board of directors, plus the 5 Federal Reserve Bank presidents, make these decisions. So basically they vote and say, you know, we want interest rates to go up, so we're going to sell more securities. We want interest rates to go down, we're going to buy more securities. And so this group of people votes on what to do with open market operations. Okay, so OMO, open market operations. This refers to the Federal Reserve Bank buying and selling treasury securities or other assets. So if you remember from our banking chapter, right, we've got a bank balance sheet, and on one side we have assets, and on the other side we've got liabilities. And so to increase the money supply, let's say they're going to buy $1,000 of U.S. Treasury bonds. So they buy this, it creates an asset. And it's also going to create a $1,000 liability in the form of digital currency that they then send to the government when they purchase this bond. So sometimes you'll hear about the Fed increasing their total assets or increasing their balance sheet, and that is talking about this, right? Adding assets and then adding liability. So buying securities increases the money supply. So anytime the Fed purchases a security, they have to create a digital currency to do so. They do not have just a bank account of their own or a certain limited number of dollars. Any amount of digital currency they create is just added to the economy. Okay, so we'll have, I'll draw this, will be my Fed bank. And they want to increase the money supply. So they're going to create digital money, and then they're going to use it to purchase securities from the rest of the economy. So this could be the government, this could be individual investors, this could be from, you know, large banks, whoever owns these assets. And so these people will give the assets to the Fed, and in return, the Fed will give them money, digital currency. Okay, so this is what buying securities or buying bonds looks like. The Fed buys them, they end up with more bonds, more assets at the Fed, and banks, government, whoever ends up with more money. Okay, so money goes in, money goes out, assets go in. Now down here we have a graph showing the money market. So on the bottom we've got quantity, so the quantity of money, and up here we've got interest rate. So what's going to happen with interest rates? So let's say we're going to start out at E0, and we've got an interest rate of 8%, and we've got $10 billion in the economy. If the Fed wants to lower interest rates, so they say interest rates are too high, we want to lower interest rates, what they're going to do is buy securities. So as they're buying securities, they're increasing the money supply. This increase in the money supply leads to a new equilibrium with a lower price, right, or a lower interest rate. So buying securities lowers the interest rate. On the opposite side, we've got selling securities. So now let's say there's a lot of inflation, and the Fed says, inflation is too high. We actually want to slow the economy down. So what they want to do is they want to raise interest rates. Okay, so buying securities, this is to expand the economy and lower rates. Selling securities, this is when you want to contract the economy, shrink the economy, and you're going to increase rates. So during times of high inflation, 2023, you see the Fed increasing interest rates. And they're actually doing that by selling securities. So they take all of these bonds that they have, all of these other assets, and they sell them. Okay? So they're selling their bonds. They're giving the bonds, they're giving the assets back to the economy, right, to society. And in return, the people buying the bonds are giving money back to the Fed. And the Fed does not spend this money, they don't use it, it just simply ceases to exist. So when you're looking at their balance sheet, we've got assets over here, liabilities over here. So originally they bought more assets. So they increased their assets by 1,000 by buying a bond. And then they increased their liabilities by 1,000 by increasing the cash in the market. When they sell that security, say they sell that $1,000 bond, they're going to just subtract 1,000 from both sides. So then there's going to be $1,000 less in the money supply, and that asset goes back out into the economy. And so when they do that, they sell securities. It's going to decrease the money supply. Right? Decrease the money supply and raise interest rates. So at that new equilibrium, now we would be at 10%. So the Fed has access to unlimited digital currency to buy securities. Now, the type of securities they purchase, the amount, that is currently decided by the Board of Governors, the FOMC. They sort of make all of those policies and general practices that they plan to. So because they have access to unlimited digital currency, the main limits on how many assets they can buy is just what's available for sale in the market. In theory, the federal government could just issue new debt that the Fed could buy directly. So if they work together, there could be no limit to, this creation of money. Currently, I think the Fed might have about $9 trillion of assets, something around there. So it's not the entire money supply that's determined by the Fed, but they do have a lot of power for increasing and decreasing the money supply. The assets have increased greatly since 2008. So prior to 2008, they did, some open market operations, but after 2008, the economy was in a fairly deep recession for quite a long time, and all of their efforts for lowering interest rates weren't working too much, right? They needed to get them very low, and because of the slope of those supply and demand curves in the market, they had to buy a significant amount of assets, and they actually drove interest rates near zero. So between 0 and 0.25% was their target rate. The problem when you get down to 0 is that they can't lower interest rates any further. So you end up in some kind of liquidity trap where the economy has not returned to its long-run GDP, but rates are near 0, and so the interest rate is the main thing that's influencing aggregate demand. And so their power, their ability to influence the economy or help stimulate demand sort of stops as interest rates get near 0. So what the Fed is targeting is actually called the federal funds rate. They don't set this rate themselves. They don't actually set this rate directly. This is the rate that banks charge each other to borrow and lend money overnight. Or these are very short-term loans. So if, Chase Bank wants to borrow money from Wells Fargo, the federal funds rate is what they're, going to have to pay. So let's say it's 1%. Chase would have to pay Wells Fargo 1% to borrow money. The federal funds rate is going to be sort of the basis that the banks are going to use for deciding how much to charge their customers if they lend money out to them. It's going to be related to the discount rate as well, so how much they have to pay if they borrow money from the Fed, and all of these things are related. So if I am a bank and I'm going to be making a loan, say I'm going to give a customer a $1,000 loan, and the federal funds rate is 2%, I'm going to charge 2% plus some real rate that I'm trying to earn, right, of 3%, plus, whatever I expect inflation to be. So I'm going to use all of this information because I want to make sure that if my customers come and they try to withdraw this money, let's say you come to withdraw your $1,000, but I've already lent it out to somebody else, I now need to get a loan from another bank or the Fed for $1,000 so that I can give you your money so you can take it out of your account. So if I have to do that and I'm going to be paying 2%, then I'm going to charge my customers, or I'm going to charge other banks at least 2% on that money. So this ends up being sort of like the basis, that lower bound rate for all other interest rates. So as the federal funds rate goes up and down, usually other interest rates go up and down as well. So the interest rate I can get on a car loan or a home loan, that's going to change with the federal funds rate. So the FOMC sets a target for the federal funds rate. They don't actually have any direct control over the rate that banks charge each other. Instead, what they're doing is they're targeting a rate through the change in the money supply. So we're just going to have a vertical money supply here. I know on the last graph it was upward sloping, but let's just assume that the money supply is a fixed quantity at any point in time. And we have some sort of demand for money. So this is determined by, like transactions demand, how much money people need to pay their rent or their bills, what they plan to spend in the short term, plus how much money people want to hang on to just for security reasons. And then the supply of money is just how much currency is actually out in the system, right? Including the banks, including cash, money that's held domestically in foreign countries, but like all dollars in the US. So down here we're going to have some kind of quantity, and then on the price axis we have interest. Because interest is what people are paying for money. It's the opportunity cost of money. It's the cost somebody's going to need to charge you for the use of that money. And so interest rate becomes the price of money. So the Fed influences the rate by changing the money supply. So let's say the current interest rate in the market is 3%. And the Fed has decided that they want to have a target rate of 4%. What they can do to try to increase interest rates is decrease the money supply. So they're going to sell securities. We're going to get a shift to the left. Interest rates are going to go up, eventually to 4%. They'll just continue to sell securities until that market interest rate, the rate banks are charging each other, reaches 4%. If they want the target rate to drop, so the economy is in a recession, they want to stimulate things, they want a target rate of 2%, they're going to increase the money supply. They're going to buy more assets, buy more securities, and then get to that lower rate. So they'll just continue buying assets until rates drop to their target. So they do this through open market operations. They buy and sell assets, most of which are government bonds, so government debt, or mortgage debt that they purchased from banks. So they're limited by that demand curve, right? If demand changes for money, if people's preferences change, if people don't really care what the Fed does anymore, they say we're just going to buy and sell what we want regardless of how much the money supply is, they might no longer be effective. But at least for now, currently, they have access to enough digital currency and enough assets that they can cause that money supply to shift as much as they need to. So open market operations is buying and selling securities, generally debt securities. So in 2022, 2023, the Fed decided they needed to raise interest rates to battle inflation. Said inflation got up to 8%, started going down, but stayed at 6% for a while. And they said, okay, we just need to keep, raising that target interest rate until inflation goes down. But it's sort of a guessing game, right? They don't necessarily know exactly how much it's going to change. So, inflation is 8%. They raised rates from basically 0 to 5%, and inflation only dropped to 2%. Dropped by 2%, so it's still, 6%. Other times in history, raising this interest rate to by 5% would have caused inflation to drop by 5%, maybe even drop by 6 or 7%. So it really depends on how reactionary the market is, how much consumers change their behavior, how much people change their demand for borrowing and spending. So they set a target rate, they use OMO to change this indirectly, but they don't control people's behaviors with borrowing and spending. So if consumers think this is temporary, or if they think it's long-term, that might affect what they do. If consumers have a lot more money, they might be willing to pay higher interest rates. Okay, so here is a graph. This is from the Federal Reserve Bank in St. Louis. So you can go to their graphing tool and ask them to show you all sorts of stuff. So I have selected the federal funds target rate, the upper and lower limit, because it's always a range. So those, the blue and the green line, they look kind of like steps. There's lots of points. That's going to be that range, that federal funds target range. And then the red line, this darkish red line, is the federal funds effective rate. This is the actual rate banks are charging each other. So this is the actual federal funds rate that exists in the market. And if you look at this graph, it's sort of hard to see the distinction. It's hard to see where they go, but that's just because it actually works really well. Wherever the Fed announces their target rate is, they're able to buy and sell enough securities to get the actual market rate to change, to be really close to that range. You can see a couple areas, like right over here, where the actual rate was like higher than their target. Some of that might be because they were anticipating that the Fed was going to raise it even further. Or over here, it was a little bit lower, but still fairly close to that range, right? And so you can see the actual federal funds rate in the economy very closely follows what that target rate is. And that's because the Fed can buy and sell as many securities as they need to change those actual real rates. Here's a zoomed in view. This is just 2022 to 2023. You can see a little bit better how every time they raise that target rate, the actual or the effective rate also increases. Okay, so they do have a lot of influence over the market, even though they're indirectly setting this rate by changing the money supply. All right, so we're going to take a quick break right here. I'm just going to stop the video and I'll start another one just to make it a little bit easier for you to watch, where we're going to go through closing the gap, so how this impacts aggregate demand.